Hello, friends. Good morning, good afternoon, and good evening. I hope all of you are learning from these videos. And let me just summarize till now what are the videos we have done and what are the topics we have covered. So, we have covered candlestick patterns, we have covered trading with moving averages, then we have covered super trend trading method, Bollinger Band trading method, and scanning stocks for trading, and also fundamental analysis and risk management is also covered in my videos. So, what is the topic for today? So, today's topic is option basics. So, options is a very interesting, derivative which we are going to talk about today. And what am I going to cover in this session? So, these are the topics for today. So I'm going to cover call option, what is call option, what is put option, and what are the general terminologies in this short video. So before we start, a little bit about options. Options, calculation formulas were actually uh, derived from Black-Scholes Merton method. If you feel like why Black-Scholes Merton method, what does this name signify? So these are the surnames of the people who have developed this formula. So there were three people who were involved in this, and they won a Nobel Prize for this calculation as well. So that's a brief about options. And now getting on to our topic for today, let's get started. So, what are options? Options, is a contract which gives you a right to buy an option at a certain price, at a specific asset at a specific price on or before a specific date. Like example, if you want to buy a Nifty uh, option at say 11,000, and you buy the Nifty call option which is at 11,000 at some X premium, and if the market goes to 11,400 also, so at the end of the expiration, if the market is at 11,400, you can exercise that contract. You can still buy the Nifty contract at 11,000 and then sell it in a 400 profit. So most of the people do not exercise. As you can see, the premiums also increase along with the price of the underlying. So a lot of people just buy and sell options, call and puts, and not much of practice in exercising these contracts which are underlying. So general terms: option buyer or holder, who is an option buyer and holder, he has the right, may or may not exercise the right, and he pays the premium. Okay, so these are the major differentiators. Option sellers, or we call them as writers, has the obligation, so that if somebody asks like I have to exercise, then option writer should be in a position to give him the underlying shares or underlying contract for the index. Has the obligation: if buyer decides to exercise the option, the seller must oblige. Receives or earns the premium, so he gets the premium upfront, whereas the buyer is paying the premium, writer is gaining the premium. So these are the two major differences which you need to keep in mind. So I am trying to explain you in a very simple model, not complicated too much for you to understand. So it is very simple, and if you want to really go deep into all the formulas and calculations, you can always Google it and go down and understand that. But it is not going to help that much in any ways. Okay, so now what are the terminologies which are used in option? Like when you are into trading options, you will get to see a lot of these terminologies like market lot. What is a market lot? So market lot is the size of the contract which you're buying. Futures and options, you have lot sizes. Like in equity, you have, like, if you want to buy 10 shares, you can buy 10 shares. If you want to buy 100 shares, you can buy 100 shares. But in futures and options, you have a contract size and it has an expiration date. So the lot size are defined by the exchange. Like for example, Nifty has a lot size of 75 and Bank Nifty has a lot size of 20. If you go to any stock and see what is their lot size, like if you go to Reliance, the lot size minimum one lot is about like 500 shares. So that is the reason any movement in the underlying in these futures and options contract give you a lot of money, because the lot size is fixed. Whereas, and the risk is also big in terms of futures and options. So that is a different topic we'll cover in the later videos. It will be too much for you to understand that. So, and the second terminology is strike price. What is a strike price? The strike price at which the underlying stock can be bought or sold by the contract buyer. Example, Nifty is at 11,000 strike. So I will show you the option chart so that you can understand better. First, let's cover the general terminologies, and then expiry or expiration date. So there are like dates for every contract. Now we have weekly contracts in Bank Nifty and Nifty. Earlier they used to be monthly contracts, but in stocks we still have monthly contracts. And option holder, the buyer of the option writer, the seller of the option. Exercise day, the date when the buyer or holder of an option exercises the option. So this usually happens on the date of expiry or maybe one day after that. ITM strike price, out of the money. A call option strike is above the stock price. A put option strike price below the stock price. So let me just take you to the option chain chart and try to explain. This is the expiry date. As you can see, we have weekly expiries, 19, 26, 3rd October. So all the weekly expiries are this. 26 is a monthly expiry. So let's go to 19th expiry and underlining index. So this is the spot price, 28,098. Now if you see, the spot price is 28,098. So 28,000 call and put is at the money. So the strike which is nearest to the spot is at the money, and the strike which is far, like 27,900, is like one strike out of the money. And then 28,100 is also out of the money, and 28,200 is like far out of the money. 28,300 is also far out of the money. And if you can see this colored things, like 27,900 is in the money, 27,800 is deep in the money, 28,100 is in the money, and 28,200 is deep in the money. So this is how we read the chart. We also get a lot of information like what is the IV, what is the last transaction price, net change, change in open interest, open interest. So open interest and itself is a big topic which is very confusing. So let's cover it in some other day. And this also gives like what is the open interest on call side, what is the open interest on put side. As you can see, put side call interest is high, so the market is bullish. There are a lot of ways to read this data which can be looked at. Now let's understand little bit about call option. How does the call option work? So call option, when you're buying a call option, your view is bullish. Call option is also called as long option. So how does that work? So if you are bullish on Nifty, you're buying a 11,000 Nifty call option. So this will be the payoff diagram for that. Like you have limited risk. The risk is only the amount which you have paid for buying the call option. And what is the reward? If the market starts going up till the expiry, so your gain will be maximum till expiry of the contract. So the risk to reward is really great. View is bullish if buying a call. Okay, now let's go to a live example. I will take you to my favorite tool, which is Upstart Define Edge. Here you can actually try and test these strategies. Let's say you are working on bank nifty, select bank nifty, and you have seen the option chain spot is at 28,098. So I go and see 28,000 call. So option price is 305, implied volatility is 15.45. So we buy this one lot and we add the position. So this is your call option. Your max loss is 6,100, which is this 305 rupees which you have paid to buy this. And what is your profit? Your profit is unlimited, undefined, not unlimited, and it goes up to 75,000 till the date of expiry. So your break-even point is 28,305. So if the market starts going below this 28,305, then you start losing money. So first 4,000, 3,000, and then your maximum loss will be 6,100. So this is call. And now let's come to the put option in a similar way. So if you're going for 28,000 at the money put, you buy the put, price is 159, add the position, and see here. So the direction has changed. Earlier your view was bullish, so you're buying a call. Now your view is bearish, so you're buying a put. In put, your max loss is minus 3,000 because the premium is low on the put side. Call side has a higher premium, and profit is undefined. So this is the profit potential, 65,000, 50,000 with one lot. This is the kind of potential you can book. If you're not happy with this 3,000 loss, you don't want to take this, what you can always do is you can put a stop loss at using any of the strategies which I mentioned in the past, like super trends or moving averages, and keep the stop loss on the lower side, lower peak, swing low, and then reduce this cost as well. And if the market goes in other direction, you'll be losing that much amount. But this is a very good strategy, a very simple strategy. A lot of people can buy and wait for getting this in, but your view has to be right all the time. So you need to have a strong technical analysis. It needs a lot of technical analysis to analyze the chart and then take a decision whether market will move up or down. So there are various strategies you can use to combine these two and come up with a lot of low risk strategies or delta neutral strategies, which we are going to cover in the next coming days. So I'll explain you in different strategies which are available, which you can use to trade safely without losing much of your capital. And if you want to check out the Greeks, you can see IV is 17, delta is 38, theta is 279, gamma is 0.6. And I'm not covering Greeks in this because Greeks are which you can actually Google and you can get to know about these details. Delta is actually the rate at which the price of the call premium or put premium moves along with the underlying. Okay, so this is a very good tool, guys, and you can use always before taking any position, and then analyze your position, like how is it going to be. So I will show you a simple example, like how your view can change. Like if you have taken a put and your view is bearish now, so now what do is we go to the option chain. We have bought a put 28,000 and we go a buy 27,900 put. So we are buying another, We are selling a put which is out of the money. And let's see how is the direction changing. So direction is not changing, it's still bearish, but your risk is now reduced further. Like it's become 600 rupees, max profit is 1300 rupees. So this is how you can play with the strategy. This is one of the simple strategies which I am showing. So if you want to further fine tune this, like if you want suddenly the direction changes and the market starts going the other way, so instead of you taking this 627 loss, what you decide to do is you can change the direction by adding one more on the sell side. So initially you have sold one put. Now you see when the market is moving in the other direction, you sell another put. So what happens is that now the direction has changed from bearish to bullish and your profit is locked. Your max profit you can gain is 3900. Market goes anywhere here, you'll make about 1900 rupees, but your risk is become undefined. So if the market again changes the direction, you need not wait till the market changes the direction. You can simply, if the market starts moving back, you can exit at this 3000 rupees profit. Or in case if you don't want to exit and hold till expiry and the market changes direction, you can always close one position and go back to the earlier direction. So this is how you can keep switching with the direction of the market and make profit out of this. Is a very simple strategy you can use, and it is fairly simple to do it on intraday as well. You can try, and you have to be very calculative in doing this. So otherwise the risk to reward in this model is very good. You're buying one put and selling one put. Your max loss is 600 rupees, which you're going to lose. Max profit is 1300 rupees. So this is one strategy which I suggest for every beginner to start with and play around with options. So we have covered call option, we have covered put option, and then I have shown you some strategies as well. So for this week's video, I think I've covered all the topics which I have promised. Next week, I'm planning to do a video on different kind of strategies in options which you can use. I have given you a glimpse of what can be a strategy. So I will leave on this note for you to understand and go through my videos again and again, because there are a lot of finer points which I keep discussing. And I always say that risk management is the most important thing which you need to learn. That is the only holy grail in the market. If you are able to master that, you will be successful as a trader. Okay guys, thank you so much for watching, and have a great weekend. See you.